and move on. I don't have that curiosity. It's an instrument it's never interested me, you know? Buying something for a fixed rate of return doesn't excite me. I want capital appreciation. I don't want current income. I get to the equity part, I look at, you know, asset management firms, hedge funds, you know, then maybe I would do them. So I would just say it's on your level of interest on a particular subject area. I don't think it's as necessary. I think we'll cover what the critical points from the reading are. So if you read and you come to class and pay attention and interact, you don't need to do the questions at the back of the chapter.
I'm because I couldn't answer most of them when I went to try to do something.
Well, then maybe you need to read over.
Are your exams more like, there was a lot of vocabulary and definitions and blah, blah, blah stuff that is not so much functional as the concept? Are your exams more concept-based or directly out of the book?
Yes.
Yes to all the questions.
Now, listen, you're going to see the exams are really easy.
Accounting easy, or like, what are we talking about here?
No, they're a little bit more
Like,
difficult.
should I remember what the
class
actual definition is, or just?
No, listen, you know, one of the things I also, people are asking, oh, you know, I like to take a lot of notes on the computer and all that. I think this is really a class that if you pay attention, if you read and you pay attention and you ask questions and you interact, you're going to absorb the substance that you need to know for the exams, okay? And hopefully you're going to learn the critical components of what we're trying to convey here. And again, hopefully what we're trying to convey here is going to help you with your career in real estate. And maybe with some personal finance issues as well, okay? The book also talked about intermediation and the process of different, intermediaries. And then went on into detail in some of the intermediaries, depository institutions, life insurance companies, finance companies. I went to this whole Financial Modernization Act of 1999, which basically put the deathbed on, talked about Glass-Steagall, and that was the last bit of Glass-Steagall. And then they talked a little bit about investment companies, ETFs, mutual funds, asset managers, things like that. So I'm going to try to go, not in the same order as the book. I've kind of grouped, so I'll distribute my slides. My slides are bullet points. And my slides are bullet points that come from a variety of different sources. They come from the publisher of this book, Modigliani. So this guy was, this guy's like one of the fathers of modern finance. He's dead now. And then Fabozzi was one of his sort of disciples. And Fabozzi is still alive. I think he taught or teaches at Yale. And Fabozzi with other people have published about 100 books in finance, including some that are focused on just real estate. So, the exhaustive and very well quoted authors in the finance realm. So from this book, from textbooks when I did my master's, from things I picked up from instructors, from things I picked up, and from things I've created. So there's sort of a grab bag of, different stuff. It's not, some people sort of just get the publisher's, notes and sort of read them through. And I've tried to go a little bit beyond that. I'll talk first about financial markets and the importance of financial markets. And when we talk about the importance of financial markets, I really want to go back and say, what's a market and why is a market important? And the parallel I draw to that, or the base I draw to that is going to a very primary economy. So let's be a primary economy, okay? Irene is a chicken farmer. So she raises chickens and the chicken farmer has eggs. And Chad has cows. And so Chad has well, if you kill the cow, then you can't give milk.
At a certain age, a milk cow stops giving milk. So at that age.
He does have cows.
Yeah, I don't know much about this, but I think the guys that do dairy, like milk, don't do beef. You can't kill the goose that lays the golden eggs, okay? And Frederick he has an apple orchard, so he sells fruit, you know, and so on down the line, right? And we can go through, you know, everybody else. So like Diana has, she's a fisherwoman. So she has fish, okay? And Victor, you have goats. So you have goat meat. Goat meat, I don't know, whatever they use in the primary. So these people lived, since goats roam over us, you know, notice how far away you are from everybody. Goats need a lot of, because what do they eat, paper?
Well, they eat grass.
No, not goats. Who's like from the islands here? What do goats eat in the islands?
Grass.
Whatever there is. There ain't no grass in most islands. They eat paper, bottles, they eat whatever. You know, no. So you need a lot of space from it. So in a very primary economy, right? You can't just eat eggs, right? So she would get in her buggy and take a trip over to Chad, Frederick, and then over to Diana, or Victor, and back home. And she'd do her business there, right? And you know, just, I mean, we could do the math. I'm not going to do the math. Just figure the number of trips that each person would need to do in order to transact their business. At a certain point, somebody said, hey, real estate developer probably said, hey, retail developer in particular said, why don't we have one central market, right? And if we have that one central market, now everybody doesn't have to do all these trips. Everybody can make one trip, right? Well, before Publix, if you go, have you ever been to the old continent? You ever been to Europe?
Yeah, I lived in Spain.
Okay, so los mercados, right? So everybody goes to the market, you give them puesto, right? Everybody has a, right? So now you only have 5 trips. So now everybody can come in, set up their little kiosco, right? Their little thing, right? And just 5 little stands, and now everybody gets fully satisfied, right? Much more efficient than everybody driving around and trying to find everything. So from just a transportation perspective, it's a heck of a lot more efficient, right? Well, stop to think that from a financial perspective, it's the same thing, right? If ultimately, let me get, I want to replicate the slide that I have here. I'm going to talk about all this stuff. Got it all memorized. So ultimately, in a financial market, what are we after? Money, right? Capital. Debt or equity, right? So we're looking for money, right? Imagine you got to drive around everywhere looking for the money that you have. And in addition to that, the issue that we have is that maybe you have some of the money, maybe you have some of it, and I got to make 8 trips to get the money that I need, right? The conditions that you have are different than the conditions that you have. So again, through an evolution of financial systems or intermediaries, we've created a process of, well, before I get to that, okay? Basically, there's 2 kinds of people in the world. I know, men and women, that's one thing that we can do, there's men and women. There are 2 kinds of people in the world. What kind of people are those as it relates to finance?
Risk taker?
Well,
Those who need it, those who have.
those who have, so we have those who have and those who want. Okay, we could say it in a different way. We have savers, right? We have savers, right? And we have users, right? So we have people that postpone consumption. We'll talk about this later because we think it's easy. It's not. We don't save. We postpone consumption, as opposed to people who need it all now, right? So I can say I'm going to wait till later and give this guy. It's kind of a concept we'll bring up about next week when we talk about interest rates, right? Because there's a cost to postponing consumption, right? Who typically are the savers in an economy? Well, we could say wealthy, but
Retired.
well, banks are not people, right? Banks don't save. Now, banks may have retained earnings, they have capital requirements, but conceptually, believe it or not, households, individuals are savers, and corporations are spenders. Now, that's not to say that as consumers we don't spend, okay? But in the general flow of funds, stop to think about it. If we were talking about the fact that there's institutional capital out there and there's pension funds, who are the pension funds in the benefit of? Who are they for the benefit of? Individuals, right? Individuals. We talked about an IRA, a self-directed IRA. Quincy, what's an IRA for? Who's it for? Somebody's money, right? So at the end of the day, the people are the ones who are saving. We talk about one of the economic barometers people are always measuring are capital expenditures, right? Capital expenditures. Why is that important? Because if I buy a car, that's $25,000, $30,000. If GE buys a nuclear reactor, or builds a nuclear reactor, how much are they charging for that? You know, billions or hundreds of millions, right? So at the end of the day, as individuals, we don't matter. Corporations matter, right? If I buy a house, a few $100,000, if somebody buys a building or builds a building, it could be hundreds of millions of dollars. So the real spending is here. So the whole process, the whole thing in finance is, how do we get money from people who save to people who use? Now, in a very primary environment, we've got direct relationships, right? We've got this guy finds this guy and cuts a private deal. Well, there's a lot of issues involved with that, right? So I want to talk, I wish I could memorize all these things. So we've got some macro benefits of trying to eliminate, and we've got some micro benefits, okay, of trying to eliminate. So the most direct, the most primary, like the primary markets, right? The users go out and seek the savers and try to cut a deal. But we can create a market here in the middle, and this market are financial markets, right? Financial markets. So we can create financial markets, and in this market, we're going to introduce a person called an intermediary, right? And we're going to call this process of putting savers and users together, we're going to call that process intermediation. So intermediation is a process by which funds flow from users to savers and back. So instead of having this direct relationship, we're going to have somebody in the middle, right? Kind of like that central market that I drew before, all right? Now, there is a process, I'm just going to mention it now, there's a process called disintermediation. And disintermediation is what? It's when this intermediation process breaks down. Does it ever break down? Has it broken down in our lifetime? When? Give me an example. I can think of.
Housing crash? Housing crash?
Okay, well, give me, be more particular about it.
Increase when they have the banks and banks.
Well, you're talking about, you're talking,
The users.
Increase when they had to run on the banks, wasn't that a breakdown of some stock?
I can tell you Mt. Gox for Bitcoin goes with disintermediation.
is that Noah?
Yeah.
There was a Bitcoin guy in the class.
Yeah. But there was a huge disintermediation.
You remember Dylan?
That's what, get ready, the next year.
Okay, no, listen, so, hold on, yeah, Chad, go,
I was just
Chad,
gonna say
go.
that there was, the savers gave the money to the intermediary to build a lot of housing or, you know, residential. The users then built, but were not able to sell the houses, whether it was due to defaulting loans or whatever. And so they had no money to pay back to the savers, and the intermediaries, you know, were stuck with the bill.
So we're, a lot of you guys are talking about, I know that's not spelled right, okay? Intermediary. I need, okay?
What's the first one?
I'm gonna explain it so you can read my hieroglyphics. No, so, intermediation is a process by which funds flow from here to here and back. So what happened during the housing bubble is, or the crisis, 2008 crisis, a lot of financial institutions were in distress, right? They stopped lending, right? Does that mean that people stopped buying houses?
No.
So in this case, it wasn't corporations. Individuals who needed mortgages would go to the financial intermediary who would provide the funds from savings, right? Hard money loans? Friends and family? Relatives? You need to buy a house and you can't get a bank loan. All of a sudden we had, hey, I know a guy that'll loan you money. He'll break your legs if you don't pay him back. Or, you know, my nephew the other day, he can't get a mortgage. But my brother and my sister-in-law are the bank, you know? Guy talked to the other day, my grandparents provided the mortgage to my house, you know, because I'm giving them a great rate, 3%. No, because you can't get a loan and your grandparents are doing you a favor. That's a process of disintermediation. I'm going to give you another example, and maybe most of you are too young to remember this. Historically in this country, everybody put money into a savings and loan. So I was a little kid, there was a bank called the Coral Gables Savings and Loan. I'd mow the lawn, my dad would give me $1, and I'm not kidding, you get $1, and you run down a little passbook savings account. I'd give the teller $1, and they'd like put $1. I remember when I had $30 in my account, I was like a Ranger or something like that, you know, and you get like a toaster oven at the end of the year, whatever. So there was a process in this country that worked for many years in which people would go to a savings and loan, and savings and loan would provide home mortgages. That's just, people put their savings in home, in savings and loans would provide mortgages to people. Merrill Lynch came out in the mid-1970s with a product called money market funds, and now accounts. And all of a sudden, they were paying not 3% on your savings, they were paying 12%. What do you think happened to this process? It totally broke down. It totally broke down. Until eventually, the financial intermediaries began offering that product. But people all of a sudden stopped providing their funding here. These people could no longer provide mortgages, plus they were getting 6% interest here, but now they had to pay 12% to compete with other people, and they went under. Okay, so this is a continually evolving environment. Financial markets in particular, not apologies, I wrote them backwards. Well, it doesn't matter, listen. Yes, let's talk about benefits. Yeah, talk to me. But what? One said macro, one said micro, forget it. Let's just say benefits, okay? Let's call them benefits. There are many benefits to the intermediation process, okay? Number one, pragmatically, financial intermediaries provide a payment mechanism. If we don't have banks, how do people pay one another? How does money flow? So the most important thing that banks do from a pragmatic perspective is, and I say banks, intermediaries, REE depository institutions, they provide a payment mechanism, okay? So you can deposit money, you can pay somebody, okay? Let me talk about I think these are the macro benefits. Operational, okay? So from a mechanical perspective, the fact that you can deal with one intermediary is going to make it a lot easier than having to make all the different trips to all the different potential sources of funds. Allocational efficiency talks to the fact that this intermediary is going to allocate funds to where they're most needed at the most effective price point. And the reason they're going to be able to do that is because there's going to be informational transparency, right? Because if I go visit 5 different potential lenders, but I don't know what the prices are. Have you seen those insurance or the place at the lending tree?
Yeah.
What, you go to one guy and he gets you a bunch of different quotes? Wow, imagine that. Now you got price. Now you know who the best guy is. But if I go to just one bank, you're going to tell me one rate. If I go to another bank, tell me another rate. If I go to an individual, they're going to tell me a different rate. But now if I've got a financial market with published rates, right? If I go to a financial market in which instruments are traded that have a particular prevailing rate, all of a sudden information is widely known, right? And because information is widely known, it can be priced properly. And if it's priced properly, the resources are going to go to the person who needs the most at the optimum price. at the end of the day, in a free market, right? It's all supply and demand. You need it, you're gonna pay for it, based upon the availability of funds. So the fact that you've got central financial markets are gonna improve the efficiency of the intermediation process. Additional benefits are much more pragmatic, and they ultimately talk to, I save money. I want to loan somebody money, okay? But you need to buy a building that costs $50 million. I only have $1 million. Where are you going to get the other 49? What, do you have to go to 49 other lenders, right? Specifically, I can loan you $1 million, but I need it back in 6 months. You're willing to wait 2 years, you're willing to wait 5, but I need, the guy buying needs it for 10. So now you got somebody that can pool money together and using their own resources as well, guarantee the liquidity. If we all went to the bank today and asked for our money out, would we get it? No, the bank doesn't have, the bank reserves 10% of their capital. Everything else is invested. But they're betting on the fact that we don't all need the money at the same time. Why was there a run on banks in Greece a few months ago?
Everybody needed the money at the same time.
No, did everybody need the money, or did everybody was afraid that the day they went to the bank there wasn't going to be money? I'll tell you a personal experience. Some years ago, I have my money. I use Schwab primarily but day to day I use a credit union. I was a member of the old Eastern Airlines credit union. I've been a member there since like the early '80s or whatever. And what's that mean? It was always in good health. I didn't keep a lot of money there. Whenever I accumulated any kind of money in that account, I would transfer to Schwab. And I got like a bonus check, or I exercised some options or something at one point. And I had a couple $100,000, and I had it in the credit union. And I kept saying, I'm going to go take it out of there. I'm going to go take it out. I'm going to take it out of there. And it was still, months went by. And one Sunday, I opened up the Miami Herald and said, Eastern Airlines Credit Union nears bankruptcy on bad real estate loans. I said, I go, of all people, I go, what an idiot. How can I be such an idiot? What do you think I did Monday morning? Dude, I was at the bank getting the cashier's check at 8 o'clock in the morning. Now, surprisingly, I didn't see anybody else there, because nobody reads the newspaper anymore, right? Because if people would have read the newspaper,
That's why you want us to read the paper.
you don't know. So, I got my money, and sure enough, within several weeks, the bank was intervened by the regulatory. Now, at the end of the day, what's happened in this country, which some economists argue is not the right thing, the government has generally stepped in every time there's been a bank failure in this country over the last, X number of years, and essentially made everybody whole. Which ultimately makes the government, the guarantor of all deposits, not just what is guaranteed by the FSLIC fund, or the FDIC fund now. How big is the FDIC fund? Does anybody know? Any idea? Last time I checked, it was $60 billion. How many trillions of dollars of deposits do you think that backstops? I forget, but it's several trillion. It's like 5 trillion or something like that. So, obviously, if all banks went bankrupt in this country, we'd have a problem. So why do you think the government intervened in 2008 the way they did? Why was there TALF? Why was there TARP? Because ultimately, we'd have a total meltdown. We'd have a total meltdown. So, anyway, so maturity's an issue, right? So liquidity. Hey, I want to be able to just cash in on any day. Maturity. I need it now. No, I need it for 5 years. No, I need to borrow it for 10. And ultimately, risk and concentration, right? If I loan it all to one person, there's all my eggs are in one basket. If I give it to an intermediary and that sort of gets parsed out, it's kind of like the commingled or the separate account, right? So now you can spread that deposit, that savings over a wider array of potential loans. And so, that's the benefits that we get. So the whole process of intermediation getting funds from savers to users. There are benefits that provide efficiencies, information, transparency, and hopefully optimal pricing and allocation, right? And they are going to provide us with the ability to address volume, liquidity, maturity, and risk taking. Okay? Make sense? All right. Let's see if I missed anything in this area. Okay. We're going to talk about this a lot. I'm just going to mention it in a brief moment. Two things. So, the more sophisticated an economy, the more sophisticated the intermediation process. The more primary an economy, the less sophisticated. If you were in Zimbabwe today with a broken financial and political system, probably any sort of intermediation is done in a direct primary basis, right? You know somebody with money? They provide capital for you. If you are in a Western European economy or the US, you're going to have all sorts of asset management firms. You may have sub-intermediaries along the way, right? There may be conduits, right? So, with securitized instruments that sort of flow through, all right? So you just get a more sophisticated intermediation process. The next one is, because of these benefits, especially the informational and pricing efficiency, people have developed in the capital markets what is referred to as the efficient market theory. Efficient markets. And the implication is in an efficient market is because all information is widely, freely available about past and future expected events, right? All prices in the market already reflect that information. So when I talked about earlier that somebody was saying because bond rates have gone up 120%, they're expecting real estate rates to go up. One of the implications of that comment is that the market already has priced all the information about what's going to happen. If you watch like CNBC or Bloomberg or Fox Business News or whatever, people are talking about, well, that's priced into the market, that's priced into that stock, that's priced into interest rates. People will tell you today. So we've had all this going on since the beginning of the year about the Fed raising interest rates this year. We're in October, almost November. 10-year treasuries have essentially been between 200 and 220 basis points since the beginning of the year. With all that speculation going on, the market already knows what to expect and has priced it. There's been very little volatility because even with all the anticipation, rates haven't moved. And in fact, when it's been time to make decisions, they haven't moved because the underlying economy is saying it's not time yet. So, when we talk about the efficient market, we'll talk about this in a lot of different efficient market theory. You talk about weak, semi-strong, and strong. And again, the more primary an economy, the less efficient the theory, right? So, again, I don't want to offend anyone, but for example, if you're going to trade shares in India or in Malaysia, there's probably going to be a high likelihood that there's a lot of insider trading, there's a lot of information that's not widely and freely available, okay? And hence, prices aren't going to reflect that. And people are going to make money, arbitrage, right? There are going to be arbitrage opportunities because of informational inefficiencies in a market, okay? Where the more developed an economy, the stronger the form of the efficient markets are. Which means that in a purely strong, efficient market, there is no arbitrage opportunity. There's no stock picking opportunity because everybody's already got all the all the knowledge out there, and that's already priced into all the securities, right? So, oh, I'm going to do all this analysis. Why? The market's already fairly priced this. Now, where do we really sit this is theory. Where do we really sit? We're probably somewhere here. Because we know there are arbitrage opportunities out there. We also know that unfortunately people trade with insider information in this country as well. All right? We know, for example, with this Valiant situation, right, that companies aren't fully disclosing all the information, right? So, you know, and along those lines, that's why a lot of times, what are the things that people, what are one of the signs that people look for investing companies? So, I always use the ponytail guys on CNBC, the ex-football players, what are those, the Nigerian brothers. They do options. And so, they're looking for options activity in stocks because they're saying, if somebody's buying or selling particular options, they know something. Because there's huge leverage in options. We'll talk about how options work later on. They know something. Market doesn't know, but they know it. And I'm going to follow all that hot money, right? One of the things that people follow is insider trades. So who are insiders? Executives at companies, big shareholders, right? And why do people follow them? Because they know more than other people know, right? And so if it didn't work, people wouldn't follow it. So, you know, there's been a stock I've been looking at. I've owned it before. I'm looking at it again. Very significant shareholders, the chairman and the CEO, and he's buying big. And I'm thinking, and the stock's down like, you know, almost 60% in a year. So I'm thinking, this guy's got his money there, and he's buying. I shouldn't be concerned. I shouldn't be concerned, you know? As opposed to all of a sudden see a company where the president sells, you know, 50% of his holdings. They'll run to the door. Something's coming. Something's coming. And I'm telling you, a little over a year and a half ago, I testified in an insider trading case in Chicago. It was based on when we sold the company. People do trade with insider information. And it does come to light. Now, in this particular case, this guy ultimately was not found guilty, but he was guilty as guilty could be. We'll talk about efficient theory. Why don't we take a little break, and then we'll wrap it up and come back. You guys, hi.
That was kind of my question. It's already, they're saying it's interest rate.
The problem, so that could be, that could be
It's just
one.
a demand issue.
No, listen, I don't know a lot about bonds. I really don't. There are inefficiencies in the bond markets, and there has been a lack of liquidity in certain markets. So there could be some of that. You could reach the implication that interest rates are going to go up. The problem with bonds, and in specific with triple B bonds, there is also a natural spread that exists between the credit ranges in bonds. And so it could be that there are different perceptions on general economic trends and the risk premium that should be associated with lower grade. So it could be that, hey, we think the economy is going to go bad, and hence lower rated debt should have a bigger spread to highly rated, you know. So there could be a lot of different implications in that. Again, there's more questions than there are answers.
Homework.
Homework, no, dude,
correlation.
I don't look at phones. Mother Jones, what is that?
That's not just there.
What is Mother Jones? Is that like
Bloomberg believes
set to market first
rental
rental?
home securities.
No, but that's okay.
Yeah.
No, but that's not what they're doing.
Rental homes, right?
Yeah,
So there's
but-
a rent check comes in.
No.
and there's packaging.
What they're doing is they are either doing a tracking stock tied to the ownership there, or they're actually spinning that off with the ownership there. Send me the article. They're
The
not.
one that I read was talking about how you purchase bundles of the rents.
Are you going back home today?
And I'll find the article.
That could be a tracking stock, but that's an underlying equity interest. That's not a securitization of rent.
I'll find the article I read.
That's what I gotta move.
Oh, you know what book I was gonna say you should read? Which is good.
Which is that?
Straight to Hell. It's by John LaFave. He was one of the biggest bonds traders for Goldman. No, he was with Solomon Brothers, and then he switched over to Goldman Sachs and ran one of their Asian markets.
And
It's called Straight to Hell, and he started the Twitter account, since you love tech, called GS Elevator, which was supposed to be all the deals heard on the Goldman Sachs elevator, which turned out was not the Goldman Sachs elevator. But it's a pretty good book.
Right.
Straight to
The
hell.
only thing is.
And also, if you like Michael Lewis,
The workshop.
have you ever read any of his stuff?
I read a lot of periodicals, I don't read a lot of like books.
You're doing a tour.
Michael Lewis, one of my favorite books is The Big Short.
Okay.
I've heard of that.
Yeah, it's really good.
You know, because towards
The,
December, that last second week of December.
And I have Thomas Piketty's book sitting on my bookshelf collecting dust.
Yeah, I've heard mixed reviews on that, you know?
I'm gonna rent that copy.
He's got a lot of hype on that.
Staying overnight.
Well, they said it was Karl Marx of the,
I've never been, the
century.
Oh, wait, so
I
he's
guess.
not doing this class?
He's good for this time, so.
speculation.
Only because Elvis Duran, Carl Moran, Anthony Renner, my friend just met them and I'm so jealous.
Oh, Lord.
That's what I'm like.
Yeah, it's right outside the door.
Do you know what I'm talking about?
Oh, no, that was,
Oh, the DJ.
Noah said it was an
Like
app.
Carl
And
Moran,
I think it's,
well, they're all down here right now for like Fridays birthday. or
What's it
whatever.
called?
Economist
Carl
Espresso.
Moran and Anthony, who do,
Huh?
like, my
Economist
Friday.
Espresso.
Oh, okay.
And my friend who does that, and I'm so jealous. Like, so, literally, we're like, what, 20 minutes away from there?
You're gonna go after?
No, I have to go babysit after.
Oh.
They're going to Hard Rock after, I wanna go stop it.
You watch this video?
Yeah, oh, yeah.
I really want to on the form, but. It is all posted teachers.
The first 2 days, like, we learned all that stuff.
I'm sorry.
We learned the first 2 days, we learned all that stuff. All the processes.
Yeah, I get it.
So you're saying there's some equities in there, in the back of
yeah,
it?
well, that would be my sense, right? Or they're either spinning off or selling equities that ultimately
Oh, I thought we were-
have an equity interest in, securities that have an equity interest in those,
Yeah, because I don't know.
in those homes.
Yeah, and it needs to be on Thursday.
Right,
So,
yeah, that's right, he releases it Sunday and it's due Thursday.
But he didn't release it.
Right, that's what I'm saying.
Oh, he releases it on Sunday?
He'll release it Sunday.
Oh, tomorrow.
Tomorrow, yeah. Sundays he releases.
And then the other guy has a bunch of that.
No, yeah, none. So you go on the Blackboard and put it on the syllabus and, you know, it says law or whatever.
Yeah,
But
but
he emailed them.
he even emailed the syllabus,
Yeah,
but there's nothing in back.
yeah,
But when
okay.
I looked into it,
Somebody told me.
I bought this thing real cheap, 3 bedrooms.
You know what? I read the first 2.5 chapters of
Interest free, start getting one payment, and then you're paying. I'm doing this, I'm busy working, it's gonna cost me so much to get hard money to do it. I weighed the 2 things, I said at least it starts liquidating. If he's a contractor and he runs into any problem, I check it out.
Yeah, yeah, the real world.
You know, you gotta trust the person.
But,
You
I look
gotta-
at it, I have a good attorney, I drop everything in Georgia.
Yeah, but listen, and that's important, but the minute that you gotta pull an attorney into a transaction, everybody loses.
Before, I did it before.
No, I understand that. What I'm saying is if it gets to the point where you have to use documents that you used to repossess a property or something, or to collect,
I mean, it's like 30 days to this.
one thing is the right, the other thing is like enforcing them. I'm just saying, there's money, there's headaches. If you use an attorney, great. If you structured it the right way, great. If you guys see without risk, there is no risk or limited risk.
Yeah, I know, there was like a case in Ohio, I think Cincinnati,
You know, put money into a
FSU fans.
money market fund
What's
that would deal with
Okay, no, I was around, and I haven't finished implementing, but I want to hear myself.
No, they're
But
back
I
now.
was
Yeah.
I don't really follow you.
Well, think about this. Cook,
But I waited.
the number one running back out of Florida, from Miami. You know,
Yeah, from Central.
yeah, and like several of the top players on Florida State's team are from, that would have never happened 10 years ago. They were away.
Hey, you working in,
Yeah, it's a culture.
You told us to tweet for,
I've never seen the
I like it
SK
now.
30.
I just moved back.
There's Miami's always gonna come back. Because at the end of the day, they have things, they have boosters down here that just,
No, I bought a house down there in 2012. Yeah.
what's that just local town?
Well, I used to go back and forth, now.
That shit ain't happening. It's just not, it's a welfare. Not like here, not like here. I'm telling you, it doesn't happen to the level that it happens here. There's just no way. Because the access here is.
Oh, no.
Might as well use it and not give it to them, right? I'm gonna spoil his inheritance.
Really?
There's two parts. That's the last straw. No, that's the board of directors. That's it. Hey, the Dolphins let their coach.
Yeah, I mean, they can both come. I'd be more than happy to give them 30 minutes to, I can't give them up because I only got 4 classes and I gotta cover a lot, but I want to come and talk 30 minutes. Whatever blanket, whatever blanket, something that relates to asset management as it relates to real estate, whatever they want to do. If they already have a presentation on something that they do, perfect. Okay? Let me know. That would be great. Okay, class.
As you were.
so we all know that we're here. And
Yeah, if I send you the article, then that should be enough. That means you know what article you got, right?
yeah, no, I just want to make sure the presentation date.
No, just a picture of that now.
I saw it, put a picture of it.
No, because if I change it, I don't want people to.
Go over, because I feel like I still don't know about the structure of the test, how, like, what are you supposed to do? Because I know the next section gets a lot of, like, graphs and all this other stuff. So,
Okay.
Yeah, that's good.
Yeah, because the midterm is coming.
and then you said it's like at the end of that class day, which to me, it messes me up because I was like,
Next
take it
time.
right when we come in.
No, but you can't.
Why?
Because the information is being
Send
taught.
it.
We haven't covered all the information yet. Can't do a midterm after one class. Okay, listen,
And it's
relax,
in class.
relax. Yeah, relax. Listen, Listen to what I said. Read, come to class and listen, participate, and then I'll send you an email with more guidance on that.
But trust me, just trust me.
That sounds fair.
It says a lot, but just trust me.
He didn't say you were gonna get an A.
I failed every single one of his classes so far.
Yeah, you wouldn't be here.
I just struggled. I was doing well until you gave us a pop quiz, and everyone's grades tanked after that pop quiz.
And I had the right answers.
You remember how I said reasonable?
That was a bad one.
That was, dude, my grade tanked like 4 or 5 points for that pop quiz. The one day I didn't
Okay, guys, ladies, gentlemen,
and I finished in March or
ladies and gentlemen. Okay. A few other concepts that were, thrown about in the class that that I thought should be worth knowing. There was a distinction drawn between money markets and capital markets. There was a distinction drawn between debt instruments and equity instruments. So let's just sort of go over those really quickly and clarify them, right? So if assets are supported by liabilities and equity, liabilities are sums that are owed to somebody, right? So it's somebody has facilitated the use of money for a particular time, right? You have an obligation to repay that sum, the face value. So a loan needs to be repaid, debt needs to be repaid. Equity, on the other hand, is an underlying residual interest in the ownership of whatever's there. Said in a very simple way, I own a house that is worth $100. I owe $70 to a bank on a mortgage. What is my underlying equity? 30. Right? So it's the residual interest that I have in the assets after I satisfy all of the obligations. Pretty simple. Now, there's a lot of different structures that are in between here. Okay, there are a bunch of instruments that have features of both. For example, there's something called preferred stock. We'll talk a little bit more about these later on. But preferred stock has features of equity and features of debt. So it pays a current, income. It pays a coupon essentially, but it doesn't have preference. It's subordinated to debt obligations. Okay. There's other features. There's all kinds of other features. There are convertible instruments that are debt but can be converted, based on certain conditions. We'll go through all of those in detail, but in general, the capital that supports assets are either sums that are owed to other individuals or your underlying residual interest after you satisfy all debt obligations. When we talk about money markets and capital markets, there's a very simple distinction, and I guess the easiest way to look at that is to say that money markets are financial instruments whose maturity is less than a year. So money markets are instruments, or money markets deal with instruments whose maturity is less than a year. Capital markets deal with instruments that have a maturity of longer than a year. So by default, equity certificates, shares, are capital market items, right? By definition, probably most debt are capital market items because most debt has maturities of over a year. There's only one sort of asset class that really fits here, it's something called commercial paper. You guys know what that is? And I'll tell you what that is in a second. And commercial paper typically has a maximum maturity of 270 days. So commercial paper are short-term debt obligations that are issued by highly rated corporate issuers with a very short maturity. And because they're highly rated, they generally pay a very low interest rate. But they are highly marketable, and because of nuances in regulation, the way that the SEC has set this up is because the maturity is less than 270 days, it's sold to qualified investors. There's very little public reporting associated with it. In fact, there's no public reporting associated with it. There's really a very limited number of companies that issue commercial paper. In particular, what I'm going to refer to as commercial finance companies in particular. So, GE Capital, Ford Motor Credit, what historically was General Motors, what was it? Acceptance and
GMAC.
yeah, GMAC, okay, which is now, well, what's the survivor of that is Ally Bank, okay. So a lot of these commercial finance companies, what they would do is on their balance sheet, because they had solid balance sheets, would issue short-term paper at very low rates, and then finance what they sold. And typically they played, it was an arbitrage game. They borrow at 1 and loan at 6, 7, or 8 or something like that, okay? And they would borrow for 270 days and loan for as long as 5 years. But because they continually rolled over the paper, they were able to maintain that financing structure, okay? And so that's what commercial paper is. Does that answer the question? So just about the only thing you really see in the money markets is that T-bills. We'll talk about more in particular. T-bills are our U.S. government treasury obligations that have a maturity of less than a year as well. Okay, so the broad capital instruments are capital market instruments. Okay, so that's it's a pretty simple distinction. Talk a little bit about I talked about it earlier, and I want to just expand on it a little bit right now. There was a guy named John Williams Burr who wrote a book in 1938 that was called The Theory of Investment Value. And the fundamental theory of the book was that a financial asset, I said it before, the financial asset was worth nothing more and nothing less than the net present value of its future cash flow. And in fact, in equilibrium, an asset will only trade for that value because no buyer in their right mind would pay more than the net present value of those future cash flows, and no seller would accept less than the net present value. And so really, at that point, as much as a buyer wants to pay the least possible, if he doesn't get to that level, there's no transaction, right? And as much of an expectation as a seller has, unless he drops to that point, there's no transaction. So, in real estate, as in any other financial markets, in equilibrium, right? The market clearing prices should be the net present value of future cash flows of an asset. Pretty simple? Yeah, I mean, you know, you guys can go home, you guys have eggs. Now, how do we calculate? It's pretty simple. There's a 3-step process, right? So, you know, the first one is you have to estimate future cash flows, right? You have to estimate or calculate your cost of capital, right? And you have to do the calculation. 3-step process, pretty simple. Got it? Now you can go home. No, you can't, not yet. It's a little bit more complex than that. Now, so that's why I said in theory, it is possible that a seller of a building may have a different estimate of what future cash flows will be than a buyer. Or a buyer, or multiple buyers may have a different expectation of what future cash flows might be. So, you're doing diligence. You think you can raise rents 4%, you think you can raise them 3%, the seller thinks you can sell them 5%, and somewhere there's either going to be a market clearing price where you're going to come together or not. And typically, if it's an efficient market, right, if it's an efficient market, we should all get to the same calculation, okay? Cost of capital may be different between companies. So cost of capital, we'll get into a little bit more detail, and I'll send you the slide with a calculation, but cost of capital is the cost of capital is comprised of basically 3 components, right? So there's a debt component, there is a preferred stock component to the extent that a company has a preferred security, and there is a common equity or stock component, okay? So let's just call the summation of these three total capital, okay? So, in their proportion, the proportion of debt over total capital, right? The proportion of preferred stock over total capital, and the proportion of stock over total capital, okay? Times 1 minus the tax rate. Why? Because debt has interest, and interest is tax deductible. Dividends are not tax deductible. I'll send this to you guys. You can write it down, but basically, I mean, it sounds like really complicated, but it's 1 times the tax rate times the cost of debt. I'm sorry, times the cost. The average, left the most, times the average cost or interest rate of debt, okay? You know, you got $100 million, you've got 50 million at 3%, 50 million at 5%, your average cost of debt is 4%. 4%, and you get a tax deduction. So you got to take your marginal tax rate and you subtract it because it's deductible. Preferred stock times the average coupon rate, right? Stock, right? Times cost of equity. We won't do this today, but your cost of equity can be estimated under a couple of different methods. People use Cap Mkts, capital asset pricing model, to calculate cost of equity, and people can also use the Gordon dividend model. Okay? Just another way of discounting and ultimately coming up to a cost of equity. What would be a normal, if I were to estimate today what cost of capital would be, you're sitting at a table, somebody's like trying to talk to you about something, what would cost of capital be in today's environment? Give me a number. I need a number. Give me a number. 4%. That seems really low to me. That seems really low to me. But we can do it quick and dirty.
8%.
I'm probably gonna say it's probably somewhere between 8 and 10%. What would commercial debt cost you today? Put a number on it. 5%? I want to call 5%. What's the marginal tax rate for most companies? 40%? So let's say 0.6, right? So that's what? 3%? Let's assume that there's no preferred stock. And we're levered 50%. So 50% times 3%. What's cost of equity? I don't want to go through the whole Cap Mkts model right now, but what would cost of equity be today? I mean, throw a number. What do you think? What would be the expected return on a stock today? You want to use 10%, 12%? You want to use 10%? Let's just use 10% for argument's sake, right? Times 50%, right? So that's 5% plus 1.5%, maybe 6.5%. That might be cost of equity, the cost of capital today for a big business, not for you and me, but for a big business. I mean, so it can be very intricate, right? When I worked at Florida East Coast Industries, we couldn't do this easily. We actually had to benchmark what other companies also incurred, and we kind of extrapolated to what we thought our cost of equity should be. You know, we kind of did our own, and then we benchmarked, and then when we did all of our capital projects, we sort of had a blend between what we thought it should be and what we thought it was. Okay? But it could be very simple. Yes, sir?
You just made a comparison between a big corporation and an individual. So it prompted a question about an individual's credit rating, how it would compare and differ from a big corporation.
Yeah. Look, I don't know that you could compare it. I just think from a relationship perspective, lenders are going to deal and equity holders are going to deal differently with, you know, large corporations and individuals. The nature of the transactions is typically going to be different, right? So let's just use a real estate example. If an individual with, you know, pristine credit were to buy a house, and let's say that he buys a $1 million house, finances it for 30 years, what is he gonna pay today? Give me a number.
3.5%, 3.5%.
No, you won't get FHA on
You won't get that. I'd probably
you're
tell
not
you
talking
probably
down.
4.25 maybe 4.5, I don't know. Maybe 4.5.
Because anything above 4.6 is jumbo, so you'll pay a premium for the jumbo.
Do we have any mortgage brokers in here right now?
Well, I
Or
got,
any residential brokers doing transactions? I don't know, I haven't looked for a mortgage in a long time.
well, I got a 3%, but then I refinanced in 2012. I got 3% in 2012.
Fixed for how long?
30 years.
3% home mortgage,
Yes.
financed for 30 years?
Yes, sir.
2.5%.
Why would you refinance that?
No, I had a 6 before.
Oh, okay.
Yeah.
Wow, that's pretty low. What would a company, if you bought a $20 million office building, what would you finance it, say it's got good cash flow, it's a Class A building, it's 95% leased to credit tenants, what do you think the debt's gonna be on a 10-year?
5%? No.
I don't know, I'm gonna say, so it's gonna be a little bit less. I've got some benchmark things, I was gonna go over them, let me see if I've got, here we go, $5.6 million mixed-use non-recourse, cash out, 100% of the cost, 20-year term, 1-year interest only, 30-year amortization thereafter, 75% LTV, 3.09%. A
Renewed every year.
multifamily developer, no, this is someone looking for multifamily properties, assets between $5 and $15 million. They'll do up to 70% loan to value, 30-year term, 30-year amortization, can be fixed for 7% at 3.7. I mean, for 7 years at 3.7. Floats thereafter. Let me see what this guy's telling me.
But those aren't
Those are-
apples, because
well, I
once
understand.
amortization period's like.
I understand, I'm just trying to give you indicative transactions. Until you go to a bank and get a term sheet,
But if I was a private, or if I was an individual person and I said I was gonna pay it off in 10 years, I could probably get near 3.75% too.
You better get it for less.
Right, that's what I'm saying, so to say that commercial is less than individual, they're paying on different year scales, is what I'm trying to say, so.
That's a whole different
let's
schedule.
call it
'cause that was a
maturity. Let's
Maturity,
call
yeah.
it
that
maturity.
was
Amortization.
interest only for the first year with
So-
a balloon.
I mean, look, so,
Or not a, no, sorry, not a balloon.
yeah, but let's see, and when we get to debt, we're gonna talk about all the different components. My answer was, you're talking about different buckets, or you're talking about different transactions. If you wanna still compare them, I think, I could be wrong, I think credit borrowers are gonna have preferential rates over non-credit borrowers in the space. My personal intuitive thought was, as close as you can get to transactions of scale, I think that a credit commercial client is gonna get a slightly better rate than an individual on a transaction, although they're not comparable. And there's an additional advantage, this is generally gonna be no recourse. This is likely gonna be recourse, whatever it is. So there's already a big difference there. So, but I mean, they're different bases. I mean, I know you're pointing that out, they're different bases. Take it outside, please. Okay, does this make sense?
Yeah.
Now, interest rates are higher. Let's say that interest rate is 8%, right? You know, all of a sudden this becomes 4, right? That becomes 2. Let's say that this is 12%, right? Now all of a sudden this is 6, right? Now we're at 8, right? So, rule of thumb, use 10%, you can't go wrong. You can't do anything else, use 10%, and that's a, you know, it's like a fair return. Okay? So that's the valuation of financial assets.
You said you're gonna send that to us, Craig.
I will. I promise I will do this one, and we'll revisit this one again. We'll do this one again. Okay, assets, tangible asset, something you touch. Intangible? Invisible? No, not invisible. We typically talk about instruments that represent some sort of interest in a physical asset, right? So a stock certificate, a note, a loan debenture, you know, et cetera, okay? So we already talked about debt and fixed. We already talked. Okay, now we already talked about this, so we don't need to talk about this. Okay, yeah, I'll just use the term. The term is markets. One of the things that in the whole informational and pricing efficiencies that financial markets bring, there's something called the price discovery process. Okay, and that's one of the advantages of transparency that a market provides. If you're buying eggs, but you're traveling to a bunch of different places, you never really know until you go to the other place how much the eggs cost elsewhere, right? If you're looking for stocks and they're only traded in one place, you get a bid, you know, or an ask price on the spot from a variety of different. So when you're going to sell something, you know where it's going to clear the market, right? So there's a lot of transparency that a financial market provides. Real estate's not that easy, right? So real estate, when real estate is marketed, what happens? Again, I'm talking institutional real estate. So if it's non-institutional, people put a price on it and sell it. If it's institutional, does anybody put a price on it? No, they send packages out and they give you an invitation to bid. And then they take the top 3 bidders. Really hard. This is really hard business to do. I don't want to knock brokers, but it's really hard. You take the highest 3 and you go, hey, guess what? It's not good enough. But I'm going to give you a chance to bid more. And then you call for best and final, and then people bid more. And then you get the guy that bid the most, and you tell him, if you really want it, you got to do a little bit better, you know? Can you do a little bit better? And then you interview the guy and talk about the conditions, right? And so price is never publicly stated. Now, if you have relationships with intermediaries, if you have relationships with sellers, and in most institutional transactions, you'll have relationships with one or both, you will know where you need to be in order to transact. So while there's no financial market that provides that, right? Like in residential, there's a listing, right? And people put a price on it. You don't have that in commercial, but the information will flow if you know the right people. Price discovery. Primary and secondary markets we talked about already. And that's not, we're going to talk later on about the first markets and second markets and third markets and fourth markets. Those are different. Those are physical markets. Primary and secondary markets are conceptual concepts, right? Primary is transactions, issuances directly by a company. Secondary markets are transactions by the holders of the instruments that own, you know, those interests, right? Okay. Financial instruments, financial assets carry a series of risks associated with them. If I were to ask a single one item that people are most concerned with an instrument, especially debt, for example, what would that be? Default or credit risk, right? You're not going to get paid back, right? That's the single biggest risk. We're going to go into more detail on this in 2 weeks, but single biggest one that people are concerned, are they going to pay me? I loan 100, do I get 100 back? That's what I want to know, number one. Number two, are there other risks that come to mind? Okay, so let's take one at a time. So we talked about, you said
interest rate.
Okay. Okay, so,
Inflation.
so let's talk about all these. Let's talk about inflation or purchasing power parity, right? We talked about interest rate fluctuation. And maybe we're gonna call that prepayment risk. Okay? Any other risks? So liquidity. Somebody talked about liquidity risk. What other risks can we talk about?
What about depreciation?
Oh, exchange risk.
Foreign exchange?
Okay, to the extent that an instrument is denominated in a foreign currency, we could have exchange rate risk. But only to the extent that it's denominated in a foreign currency, right? So definitely that. Liquidity or marketability is another way to call it. Prepayment or reinvestment risk, okay, is what we're going to call this. So let's talk about the first one, inflation. So what's the risk that you're getting paid? You're getting,
You get paid.
yes,
It's less than
or what it was worth. So I loan you $100 today. 5 years from now, we've had inflation of 3%, right? The implication is, 5 years from now, that's worth like 90 or 80 something dollars of what that was. So that's definitely a risk, right? And how can we address that typically? And we'll talk about this with the treasuries. We get inflation index. Typically the only debt instruments out there that are inflation indexed are treasuries. So there are, not all, but there are certain inflation index treasuries that will protect you against that risk. Prepayment risk or reinvestment risk, or the risk of interest rates changing. So if interest rates go up, do you think you've got risk if you're the holder of a debt instrument?
Yes.
If rates go up, you're the holder, you think you have risk?
It depends on if it's.
Let's ask the good doctor his recent experience. He had a mortgage at 6% and rates went down to 3%. What did he do? Refinanced. If rates go up to 7%, what's he going to do?
Pay more.
Aren't you
You're
fixed?
Good method.
No, I see what you're saying. I'm not gonna move.
You're not going to do anything. So if rates go up, is there a prepayment risk?
No.
No.
If rates go down, is there a prepayment risk?
Doesn't it depend on
Yes or no?
the-
Probably. Is it good? Yes or no?
It's good.
The answer is yes. And what's the risk? The risk is somebody's going to prepay you. So what? Somebody prepays you.
It's before it matures.
So what? What's the risk?
You don't risk
One
it.
loss of income. The risk is that when you reinvest that money, you were getting 6% before, now you're getting 3%. So the guy that held his mortgage just got gypped. And when you say, so you go, so what's the big deal? Well, the big deal is that institutions match their funds. So a life insurance company may have entered into a guaranteed income contract with somebody where they were going to pay them 6% and they could loan money at 6% because they know they were going to be whole. But now they still got the promise of paying 6%, but they're only going to get 3%.
But isn't that when you do a prepayment?
Okay, so when we get to debt instruments, there are different prepayment penalties, either strict penalties, yield maintenance, or defeasance. There are different ways in which lenders protect themselves, get call protection to try to mitigate this risk. Okay? And then liquidity and marketability really talk to the type of instrument, the company. So if I make a loan to a private individual and I need money and he can't pay me right now, what do? Not a whole lot. Maybe I can find a friend and he'll say, okay, I'll give you 50 cents on the dollar, right? Or I'll give you a little bit less, okay? So, I mean, ultimately, I think this is something that you're going to know. Now, where this might be an issue is when you're talking about thinly traded securities. And for example, probably more on the equity side than on the debt side, but there's a lot of stocks that trade in the New York Stock Exchange or otherwise that are very thinly traded. So, maybe only a few hundred shares trade every day. If you own 100,000 shares and the average daily trading volume is 500 shares, and you gotta dump 100,000 shares, what do you think's gonna happen to the price that day? I can tell you, trading thinly traded stocks, so we're talking stocks that trade 5,000, 10,000 shares a day, buying a couple thousand shares will significantly alter the price. I've chased stuff up like $1, like, you know, from $7 all the way to $8, because it's a very thin market. Okay, so the breadth and the depth of market is going to impact value, and there is a risk associated with that. And we already talked about the fact that exchange risk, you know, so if currencies fluctuate, you could be adversely impacted when you convert back to your home currency. That. Okay, market participants. We'll make this quick. I know you guys are getting tired. Okay, so the bank talked about a series of different intermediaries. So the book talked about the series of different intermediaries. The first one they talked about were depository institutions. What were the significant depository institutions that were spoken about?
Commercial banks.
Banks. What else?
S&L.
S&Ls. What else? Credit unions. About it, right? Okay. What's the business of a bank? What is the business of a bank? A bank has two functions. A commercial bank in this country, as defined under the Glass-Steagall Act, which doesn't exist, but for this purposes exists, is a commercial bank has two functions in this country. That is,
Deposits.
take deposits
And investment.
and
And lending.
and loan money. Okay, that's it. Commercial banks cannot own equities. Commercial banks in this country cannot own any equities. The only equity, the only stock that a bank in this country can own is a share in the Federal Reserve or one of the other affiliated, you know, banks. Okay, so banks by regulation, commercial banks by regulation cannot make investments. So the one sort of distinction between a merchant or investment bank and a commercial bank is that a commercial bank takes deposits and loans money. Investments or merchant banks can make investments on their account or on behalf of customers, okay? But they can't take deposits then. So that was one of the distinctions. We'll talk more about Glass-Steagall in another class, okay?
What Bank of America?
Bank of America is a commercial bank, but Bank of America is a bank holding company. So so there was might as well jump into it now. One of the aftermaths of the crash in 1929, the real crash of the market in 1929, several bits of regulation that were important. One of them was the Glass-Steagall Act. The Glass-Steagall Act in particular created the following prohibition or distinction. It defined insurance companies, insurance activities. It defined commercial banking activities. And investment banking activities. It basically said an investment bank cannot participate in commercial banking activities or in insurance activities. An insurance company cannot participate in commercial banking activities or investment banking activities. And a commercial bank could not do investment banking or have insurance operations.
So how State Farm gets away from State Farm?
State Farm is a mutual company. We'll talk about insurance companies in a second. And that's State Farm is still a mutual company, okay? So Glass-Steagall basically creates out firewalls. Through a series of years, this was watered down. One of the ways it was watered down was the creation of the permitting of the creation of a bank holding company, in which in theory, a bank holding company would create an internal firewall, but it could own an insurance company, it could own a commercial bank, and it could own an investment bank. Okay? You know, they have different capital bases. You know, they're regulated by the state insurance regulators. This is audited by the FDIC and FSLIC guys. You know, this has FINRA or whatever whatever regulatory agencies involved. So it was just sort of smoke and mirrors, and then came the Financial Services Modernization Act of 1999, and it was really pushed for the creation of the Travelers and Citibank merger. Okay, so Travelers was a large insurance conglomerate, merged with Citi, which was a large commercial bank with large investment banking activities.
Didn't Citi buy Solomon?
Earlier than that, that's how Solomon had investment banking activities, okay? So there were several sort of umbrellas here, there were several umbrellas here. This guy Sandy Weil came up, you know, concocted this merger and sort of pushed through this Financial Modernization Act in 1999, which clearly totally eliminated whatever was left of Glass-Steagall, and essentially, you know, sort of did away with this. Now, technically, Bank of America is a bank holding company still, so the legal structure still exists, but not because it's required regulatory, you know, from a regulatory perspective. So they operate Merrill Lynch and their investment banking activities here, and they've got the commercial banking activities here. I don't know what insurance they may or may not, you know, retain at this point. Okay? Now, let me just jump ahead. What are insurance companies? So if commercial banks take deposits and make loans, what do insurance companies do? They accept premiums in exchange for assuming risk.
Right.
The concept of insurance, kind of interesting going back to Sharia law. It's kind of a sort of similar thing in the financial, you know, area. The concept of insurance is a mutual concept, right? It's a community concept. And so, well before people concocted New York Stock Exchanges and all that, insurance companies were essentially collective groups of individuals that would get together to share risk. And State Farm to this day is still a mutual company. It's owned essentially by its policyholders. Up until relatively recently in this country, Prudential, MAT, were mutual companies. A lot of the S&Ls were mutual companies. To this day, Northwestern Life is still a mutual company. And so its interest is not for profit making, although it can make a profit in order to build its capital base, but its purpose is to provide a service to its members. Okay? So State Farm sort of falls under the whole same thing. They're an insurance company, they're mutually owned, but they can provide banking or investment that, you know, definitely broker-dealer, you know, activities, or broker activities anyway, not dealer, broker activities to their members, because there's no longer any regulation that prohibits any of this. That answer the question?
Yeah.
Claudius?
Yes, sir. I think I heard you say that banks and S&L do not have assets. Now, whenever they give you a loan and there's a collateral, isn't that a...
No. They can't hold equity. They can make loans. So their assets are loans. Their assets are not... So remember the distinction between debt and equity instruments? They can hold debt instruments, but not equity instruments.
So collateral is a debt instrument. Like if you buy a car and it's financed, they can come back and repossess it.
Well, no. So you're mixing a couple of concepts, and again, we'll talk. So they make a loan. Their asset is a financial instrument, which is it could be a promissory note, okay? It could be a note payable. Let's call it a promissory note. That promissory note can have a security interest associated with it. That security interest could be recorded at a county or with a state under a UCC filing, or it can be recorded as a mortgage in the case of real property. Does that make sense?
Yes.
So collateral is a guarantee or a support for making a loan to prevent loss, to mitigate default risk, but the collateral in and of itself is not the asset of the lender. It's security for the lender. Make sense?
Yes, sir.
What are S&Ls? We talked, so the business of this, and listen, and the reason that these are highly regulated, the reason they can't make equity investments is why? Why is that? First of all, because it's everybody's money, right? And when people lose money, who do they call? The government. The government says, well, then you can't lose money because I don't want people bitching at me. More important than that, the government has backstopped all these failures. And so the government says, okay, we're going to highly regulate this because we don't want any losses. So you need to, you know, so that the auditors come in, they regulate, or they review the loan portfolio every quarter. Loans are classified based on payment activity or repayment activity. Based upon the classification, reserves need to be made against it. Reserves dilute what? The capital base of the bank, which preclude the bank from making additional loans. If the banks can't make loans, they can't make money. Okay? So credit quality is important. All right? So no,
I was going to say, so it would prevent them from buying back their own equities, essentially, doing a buyback and decreasing supply and increasing the value of their bonds.
only if they did it with bitcoins.
No, you get what I'm saying, right? Because they would.
Okay, no, okay, well, no, so. Dude, we have some devious minds here.
Because if you have a buyback, a corporate buyback, then the supply decreases, you would increase your share price, and then you could sell it in the secondary.
Okay, so let's go through business customs and practices. In certain countries, in certain developed countries of the world, in Europe, for example, in Spain, for example, in France, for example, in Spain, I'll talk to you in Spain. There's a bank called Santander. You guys have heard of Santander? In English, Santander in English, I think they have a large operation in the UK and they call it Santander. So Banco Santander is controlled by who? No, there's a family. The Botín family. Emilio Botín was a chairman, he just died. His daughter took over. Who was the golfer? Who was she married to? She was married to Severiano Ballesteros, right? Dude, I thought you were a pro golfer. Did you know that guy? He was like the best.
I played for the American team.
But Santander is one of the largest financial institutions in the world. This family controls that. This lady's dad was the chairman and president and CEO for the last 40 years. The day he died, they named her chairman, president, CEO. How much of the bank do you think they control? 20%? 51% maybe?
Family?
Yeah, family.
Oh, is their name?
60, controlling interest at least.
Wait till you get to the accounting class. I'm not going to give you the answer because you need 60% to control.
No, 51%.
Really? Okay. Well, so
You
this.
don't need any of it. You just need the majority.
You need influence.
Yeah.
Okay. You need influence. Okay. So what banks do is they so these banks they manage what they call them auto cartera. They manage their treasury stock as an active investment. So what happens is they do a buyback, and what they hold, management votes. So the company will own 4, 5, 6% of the stock in the bank, and that gives them enough influence and power to elect a chairman. We don't do that in this country. So in this country, when you buy back stock, it's not technically retired, but it's never reissued. And I should say it's never reissued. What a lot of companies, two things will happen with treasury stock. It'll be retired, or a portion of it will be held by the company. It's already been registered. The company will hold a portion of it to issue for stock grants or restricted stock, or stock options that are issued to employees. Okay, so they don't buy it with the intent of playing arbitrage in it. The reason companies do buy back the stock is to reduce the denominator or number of shares outstanding and increase the earnings per share. Now, sad comment on management. The best investment I can make with your money is to buy your shares out and undilute you as opposed to make additional investments. But that's what they're basically saying. Okay. Now, To your point though, there is an issue. Some of these banks like B of A have been precluded because of the money they received under TALF and all the regulatory and TARP and all the regulatory requirements. They've not been able to pay dividends or do buybacks because those are deemed as distributions to shareholders. So if you're buying back shareholders, that's deemed a distribution to shareholders, okay? So, I don't know if did I answer your question? Good. S&Ls don't really exist anymore. S&Ls were savings and loans. We'll talk about this a little bit more next week, but they were,
It's like a mutual.
for the most part, they were mutually owned, again, for the benefit, not for a profit motive, but for the benefit of the depositors and.
Mortgages.
Exactly. So that the traditional model in this country was you safeguard the depositors' money, and with that you make home mortgages. That's the way this country worked from 20s all the way into the early 70s. And credit unions are similar. Credit unions are similar in that they're generally mutually owned by the members. They've dabbled a little bit lately in mortgages, but historically they have been the lender of last resort for individuals. And so they'll do like payday loans, car loans, Christmas gift loans, vacation loans. And because they're somehow tied to the employer, you get like a deduction out of it or whatever. So typically a lender of last resort to individuals, okay? Any questions on institutions? Insurance companies we talked about briefly.
Where would like a crowdsourced funding fall under?
It's not part of the financial.
No, listen, we can talk. We can talk about that just briefly. Most crowdfunding that I've seen deals with the equity side of the structure. So I mean, depending on how you want to look at it, is ultimately it would be private equity that you're raising. It's not publicly traded. It would be to qualified individuals, but there's no security being issued that is no, that's not traded on a public market. Okay? And that's what I would say. It's not what I've seen. The instrument I've seen, this guy's raising money to do a debt fund. So you can do crowdfunding for debt, but again, not all falls under the private domain because none of those securities would be publicly traded. None of them are registered. Okay. The source of, I was going to say, the source of funds for banks are deposits, but in addition to deposits from individuals, we'll get into more in depth. They can borrow money from the government, right? So they can go to the Fed. The Fed is their bank. The Fed is the bank for the banks, so they can go there. And ultimately, they are regulated by the federal regulators, and ultimately, national banks or the Federal Reserves are regulated by the Bank of International Settlements in Switzerland. So sort of that's kind of like the international Fed, and we'll talk about that.
It also tells you about fees being a source of.
So banks historically made interest, and that's actually the next slide. Interesting that you saw that. So how do banks make money? First and foremost is a spread. They borrow at 3 and they loan at 6. As their businesses become much more competitive, they charge fees. On your ATM, for a loan application, a fee on a loan commitment, a monthly service fee, a processing fee, a fee on a fee. Okay, so that's become obviously banks are very subject to. Why are they subject to regulation? Because of the management involved. Because of banks have something called an ALCO, an asset liability committee. And ultimately, there's a whole matching involved with that spread.